The Wolfsberg Group is a non-governmental association of 13 global banks. Its goal has been to develop financial industry standards for anti-money laundering, know your customer, and counter-terrorist financing policies. Their work is hugely influential, and it's a cornerstone to most banks' financial crime compliance programs. On October 28, 2022, the group published an updated version of their financial crime principles for correspondent banking, and this was the first such update since 2014. I'm Jonathan Bell, and this is the future of financial crime prevention in correspondent banking in 100 seconds. So who do these principles apply to? Well, the Wolfsberg Financial Crime Principles in Correspondent Banking apply specifically to financial institutions that provide banking-related services by one bank to another bank for the execution of third-party payments, trade transactions, and processing of paper clearing needs in a particular currency. Incidentally, this is how the Wolfsberg Group defines correspondent banking activity. So they recognize that the processing of third-party transactions is no longer the exclusive dominion of banks, as banking comes out of the banks into a wider sphere. It indicates that, dependent upon their risk appetite, financial institutions can extend correspondent banking services to other entities. So firstly, risk appetite. Banks offering correspondent banking services need to define their risk appetite through a formal governance body, which is subject to specific oversight, which is itself to be approved by the bank's board. Number two, risk-based due diligence. Well, banks have got to perform due diligence on their correspondent banking customers, also known as respondents, in order to establish whether these respondents meet the criteria defined in the risk policy. The Wolfsberg Group highlights that even relationships with branches or subsidiaries of the same banking group should be reviewed independently against these same criteria. So correspondent banks should further ensure that they're not conducting any business with shell banks and perform customer visits wherever possible. Make sure they're the real deal. So when a respondent presents greater risks, the correspondent bank should perform enhanced due diligence checks on them. So number three, ongoing monitoring and review. Well, this is key. Correspondent banks need to implement policies and procedures to detect and investigate unusual or suspicious activity. And this includes monitoring the respondent's transactions and reviewing that these are in line with the information collected during customer due diligence. If they're different, that's strange. There needs to be a feedback loop between due diligence information and transaction monitoring to ensure that the risks are communicated and effectively managed between Know Your Client and Know Your Transaction processes. They've got to join up. If they don't, something's wrong. So the relationship with respondent banks should be reviewed as well on an ongoing basis, particularly for customers that present a higher level of risk. The Wolfsberg Group provides a clear and widely adopted approach for banks to identify and manage risks associated with correspondent banking activities. And we are happy to see that they've updated their principles to reflect today's realities. And we hope that these updated principles will better enable banks to strike the right balance between the ever-important risk of fighting financial crime whilst maintaining financial inclusion. So let's all get behind our friends at Wolfsberg and apply these principles as we seek to open the doors of finance to all and protect those who enter. Thank you.